The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor and the current editor and your host for today because Gaurav Sodhi has decided to take a holiday in the middle of reporting season. I just want to let Nick and Angus, who are with me here today, know that you have to be here 10 years before you take those kinds of liberties. I hope that's okay with you.
Noted.
Yes.
So we have three subjects today. I think we kick off with a question, though, which is, what do you guys think is the longest living vertebrate? This absolutely shocked me, and I have to discuss it.
I would have thought a vertebrate. I would have thought at those marine turtles. But I need to think about this a bit because I mean there's sort of bacteria on the bottom of the seafloor that might be millions of years old on the basis of the rate of oxygen consumption. But yeah, I would think it would probably be a vertebrate. I would think it would be a turtle. I know that there's some term for it where it's almost like biological immortality. So if you dissect a 200-year-old turtle, a lot of its organs have not really aged. But I'm guessing I'm wrong. Is that wrong?
Yeah. I think so. I would have guessed. What would you guess, Nick?
I would guess a shark, but I have no idea.
Wow. The non-scientist gets the scientist's answer right.
Is it a shark?
It's a shark. It's a Greenland shark.
Right.
It lives for 400 years, and they believe maybe up to 500. Just incredible. And I think that this is a good advert for ice baths because they believe that this animal lives so long because it lives obviously in really, really cold water, loves cold water, is very, very slow moving, has a very, very slow metabolism. And that's why it lasts so long. Obviously, it's got no predators either. Just an incredible thing to think that. I just finished watching Shogun again last night. And maybe there are creatures in the sea right now that were around at the time that series was set. It's just an astonishing thing.
Wow.
Just an
Do you get in your Speedos often, John, and jump into ice baths?
There are certain things that just don't go with the word John. The word's John Addis, and Speedos is one of them. Okay, so moving from one incredible fact to another, Boeing has a new CEO, Nick. I thought we'd kick off with this because it's quite fascinating because he was appointed, I think, a week or two ago, and it just came out yesterday that Boeing's only remaining aircraft program that so far didn't have too many problems has just announced massive problems. The engines on an aircraft are quite important. You know, without engines, the thing just doesn't fly. And if one comes off, it's a serious aeronautical issue, especially as a 777 has only two engines. If you lose one, then you're really in trouble. And they've just found that the test flying aircraft, I think there's 4 or 5 of them, two have cracks in the engine mount. So that fleet has been grounded and will probably be delayed, just like the 737 MAX was, just like the Dreamliner was to its customers. So this is all of Boeing's major aircraft lines have suffered, will suffer delays in delivery. Nick, what do you think this tells us about the culture of Boeing? You wrote Boeing up and it was basically an avoid because we felt the problems were too deep. What do you think this says about this company?
Well, I mean, I think that broadly says that what we wrote up was correct. It just goes to show, like, when you have a business like aerospace, which has thousands, maybe even tens of thousands of suppliers, millions of parts into these planes, there is no quick fix overnight. When the culture goes wrong, and in this case in Boeing, it went from engineering to the financialization of Boeing. So the executives moved to Chicago. They did this weird thing where they flew around the United States and then landed in a city to celebrate where they were moving the headquarters, even though all the engineers and production was based in Seattle. So there was just this, massive split between the engineers and the executives, and that was really to, cut costs and drive profits up. And that's led to all these problems that have just started to come out of over the last 5 years. Prior to that, Boeing was celebrated. It was an American success story. It was earning far more than Airbus, even though they sold about the same amount of planes. And the market loved it, but it just goes to show how deep some of these cultural problems, or how deep some of these engineering problems can run when the cultures, goes wrong. And this new CEO, I think it's a step in the right direction. For starters, he got a mechanical engineering degree, so an engineering background. He's moved back to Seattle, so he'll be based in Seattle, where production is done. And I think he was the former CEO of Rockwell Collins, that are an aerospace supplier as well. So I think that's a step in the right direction. But as your question sort of hinted at, it might not be enough. Like these problems could go on for years, even if he is actually a competent CEO. And unfortunately, in his first week on the job or second week on the job, he's found out that there's a few more bolts loose in one of their new planes. So it's just incredible.
Yeah, it just shows you how deeply set cultural problems are and how difficult they are to address. I mean, I think Boeing has taken, I can't remember when the takeover in quotation marks of McDonnell Douglas was, but that's when it started. It's probably decades in the making. I suspect it might take decades to fix. Do you think the company can survive this, Nick?
I think it has to, in terms of just in its importance to America, in not only its commercial aeroplanes, but particularly the military side of the business, which is, I think 20-25% of earnings or at least revenue. So I think the American government's going to prop it up, but what loans they're given and those sorts of things, it's hard to say. But all these problems are starting to mount because they went from having a manageable amount of debt to then having the 737 MAX problems before COVID, where they grounded that aircraft. Then COVID hit, and so now net debt is about $40 to $45 billion. This is a company that still doesn't earn really any free cash flow, and their hope was over in 2024 that would start to change and free cash flows would come in. They could pay off some of this debt, but obviously that problem with the 737 MAX at the start of the year, where the door fell out, and it sounds, it reminds me of that old ABC segment. I forget the exact, Dawes and Clark, when the front fell off, but yes. Anyway, when the door fell off, it's sort of changed their plans for free cash flow. So it'll be probably at least the first two quarters, have been negative free cash flow, and that's going to be a huge problem for the business going forward. And it's hard to see how it's fixed anytime soon.
It's interesting in these businesses that are so nationalized, and it's so integral in the US defense. You have all of these, tens and hundreds of billions of dollars getting put into these military things, and you sort of wonder how many of them would actually fly, because you would assume the malaise is going right across the organization. It's not just limited to the passenger aircraft. But
yeah, I just think in the military, it's like the Defense Department here. There is no area of the Defense Department that suggests any kind of financial management and ability to project manage a big project. But you're never really held to account, because often things are secret. People don't understand the complexity of these things. The media aren't that interested in it. Because people fly in commercial passenger planes, it's much more of a newsworthy story. So the military's part of Boeing probably gets a free ride in a way that the commercial division doesn't.
Yeah, and a lot of the military division, and why I said at the start, while the US will step in at almost any cost to save Boeing, is this is significant IP there. Lockheed Martin as well, and they just can't. They don't want that on the front page of the paper.
That's right. Okay, so Boeing is not going to go under, and even if it does, it's too big to fail. It's the Citibank or AIG of the defense sector, so it's not going to fail. But that's not to say that shareholders can't lose a lot of money in it. So I think it was a good call to avoid this company that looked attractive at the time in terms of its market positioning, but it probably is too big to fail, but not worthy of putting any money in at this point. Let's now move on to Verisign, which is a company I was completely unfamiliar with, Angus, until you wrote it up. You called it Internet's toll booth, and draw a parallel with the Yellow Pages, which everybody over a certain age remembers, struggling to carry it in off the doorstep when it was a supremely good business. Can you explain, Angus, how that parallel between the Yellow Pages and Verisign works as a way of just explaining this business to listeners in the first place?
Yeah, it's a remarkable business. Essentially it's a registry of all of the .com and .net web addresses in the world, and whenever a web address gets renewed or created with the .com or the .net address, only those ones. There's now all these other competitors, but whenever those get registered or renewed, the company basically collects $10. And I think any other business in the world, with this sort of, usually this would be kind of a public service. It's this sort of extraordinary monopoly that is owned by a private company. The business itself had this origin with the RSA, which is a style of encryption, but one of the big RSA companies, the early ones, they started with that. And so the RSA Security is the company. So Dell ended up buying it. It's the one that got into it's been in the news for a lot of interesting things. It was doing backdoors for the NSA. It was the one that the Australian government got into all trouble with, because remember when people used to use those RSA security tags?
Yeah.
So the founder came from that. The business had all these other units, and it did sort of a lot of kind of web authentication stuff. But really, it acquired this .com and .net monopoly, and then has just doubled down, and that's really the only part of the business that's left. So it's essentially a kind of a monopoly utility. But I think there's some quite interesting competitive pressures on it. But really, it's sort of much as the Yellow Pages, they were originally kind of started by a under government mandate to kind of give a registry of all of the phone numbers in the phone book. This is your .com and .net registry.
How did this become a private enterprise?
The magic of American capitalism. I think,
So you give somebody a natural monopoly.
Yeah, the Department of Commerce. So for a while, I mean, it also goes back to that origin of the internet, where it was sort of started out as a research project. And so there was a period of time where large parts of the fundamental infrastructure of the internet were kind of run by hobbyists who just sort of would, have their own server spun up where they were like hosting these addresses. So you've ended up, there's what are called root servers. There's 13 root servers of the internet, and most of them are either in the US military own them or control them, the US government, or there's some academic ones. So like I think MIT or maybe Caltech run one or two, and Verisign own two as well. And so basically, the entire web is reliant for a lot of its, I guess, underlying infrastructure on a few different servers. And now, now it's much more distributed, and there's sort of alternatives. But basically, when you're making a query and you're checking a website exists, information's kind of going around, and it's just sort of mapping out where things are on the internet. It's crudely explained, but I think it's sort of a simple way to think about it.
Okay, well, you said that it collects the third highest net margin and the highest return on invested capital among the S&P 500. It's astonishing that what should be a publicly owned utility makes those kind of margins. Why did you make the argument that this wasn't worth buying?
I think that the landscape, it's on some shifting sands. The landscape that this business was in a few years ago is changing. So essentially, the Department of Commerce, it's sort of outsourced. There's this organization called ICANN, which is sort of meant to be this not-for-profit that administers the top-level domains of the internet. Verisign has a contract with the Department of Commerce that comes up for renewal every 7 years. It's coming up again in November. There is pressure both coming from Congress and from certain sort of libertarian or free market think tanks in America trying to put a cap on this kind of regulated utility, because it's allowed to increase prices by up to 10% per year. It's sort of got different contracts for the .com and the .net. But so there's pressure there. I mean, one of the key things that I saw with this, and I was like, oh, this doesn't look good, is Cloudflare. So they also used to administer the .gov websites. It's not a big contract, .gov. It's only something like like $20 million, somewhere in that range. But Cloudflare have stepped into it. And so Cloudflare, they're famously a content delivery network, but they now, you often when you go to a website, you'll see that Cloudflare comes up and it's the DDoS protection. Yeah. They are just becoming this sort of layer of the internet. Cloudflare stepping into this industry and expressing interest in owning some of these top-level domains and some of the kind of underlying infrastructure. That to me looks a little bit like when Amazon steps in and starts making supermarkets in your hometown. Okay. So I think that is if you're sort of looking for a narrative and you're looking at things that would potentially be pretty big red flags, that to me was a significant red flag. But then, I mean, one of the biggest things here is the insider sales are about the most egregious I've ever seen. I think it was something like in the last 5 years.
That's a big call, that, Angus.
Well, that's true. That's true. Yeah, no, it's too big a call. But it is egregious. So in the last 5 years, management have sold $365 million in stock and haven't bought anything. So that's quite a lot.
Wow.
But to those metrics, there are all. When you look at the balance sheet on this business, Nick would know a lot more about this. It could give better detail on this, but they've got incredible negative equity, and it's because they've got all this accumulated deficit. They've got more accumulated deficit than shareholders' equity, but you've got your return on capital is 279%. So there's just some of the metrics with the business look so attractive, and there's some very smart money behind this. Berkshire Hathaway is the largest shareholder. So in a way you're betting against them, but I think the business that they bought 10 years ago is in a very fundamentally different place to the business today.
Which is why there are ways of taking money out of a company, and one of them is through huge salaries, and the other one is selling down your stock. And the chair and founder pays himself $32 million a year US, and those stock sales as well. They're not good signs, are they?
I think it's a red flag for sure.
Sorry, Nick, what were you going to say?
I was just going to say, I think one of the other risks that Gus brought up that I've been thinking about a lot more is just the lack of innovation in this business and the lack of, or the low amount they're spending on research and development. And it just seems to me they're just milking this monopoly, and that's really, really risky. So to be an investor in it, you've pretty much got to say the status quo is going to stay the same, and they're going to continue milking this monopoly because they're not really making any inroads into new products or services. And I just prefer, as an investor, companies that have multiple ways to grow. Like a good example is MasterCard and Visa, who are in a similar position, very dominant, a duopoly, and they could have just sat back for the last 3 decades and just milked this trend from cash to card and distributed the money back to shareholders. But they've done part of that, and they've also chosen to reinvest into new products, and that's why they now have, real-time payment networks, data analytics, marketing. They also sell cybersecurity products. And it's about, I think, value-added services for both of them is somewhere between 20 and 30% of revenue. And so that really actually entrenches their moat, whereas with Verisign, the lack of innovation really worried me. I think that was one of the great points that Gus brought up in the research, because when I first looked at the company, I was like, stock price is down, great long-term track record. As you said, John, margins are fantastic, and return on invested capital is the highest in the S&P. This looks really interesting, but the deeper Gus got into it, it was clear that probably wasn't the case.
Yeah. I think as a monopoly over the past 20, 30 years, especially in the US, but definitely here, you've had it pretty easy. The antitrust provisions in American law haven't really been applied. And when they have been applied, they've done so in a kind of strange and odd way. Here, often the courts override any sort of findings by the ACCC. We've seen that recently with a banking decision. But that seems to be changing in the US, and when things change in the US in terms of antitrust and not permitting mergers that would entrench monopolies even further, or even just addressing existing monopolies, that seems to be changing. Do you think that's a risk here too, that there might be some kind of regulatory threat as well? Very much so.
And I think, to your point about things can change quickly with governments, or one of the things that's so striking here is that it was one of the very powerful House committees that kind of wrote a letter, a public letter, saying this thing is a monopoly, it shouldn't be allowed to. It's taking advantage of US businesses. It's not the usual suspects who are kind of who are pushing this. It isn't like it's it's Republican senators, and I mean, and that shows that transition in America. The Republican Party used to be kind of the big money party in America. Now they're much more of the populist party, and the Democrats are kind of more of the big money party. And it's sort of, you're seeing, even in the types of organizations that are criticizing Verisign, a lot of it's actually, what sound to me, and I could be wrong on this. I haven't looked that sufficiently deeply into the funding, but it sounds like sort of Chamber of Commerce type stuff. Chamber of Commerce is pro-business, but this thing, it's just there was a really interesting comment. One of our very wise readers made a comment, and they were talked about the comment in the article, saying that someone had just paid $1.8 million for Dot. So what was it for friend.com, to own that domain. So that's kind of the going rate for that. But what I was thinking about with that is, well, okay, so if you're paying 1.8 million, you want that thing to be generating, say, 150 grand a year or something in revenue. Our habits, it used to be the thing that people would go and you type in the .com address, but with the rise of your internet platforms, so people are increasingly buying things through Facebook or through Instagram. I don't know if it's as essential to commerce as it was to be kind of owning that IP. And as at the moment that seems reasonable, but in 10 years' time, do I think people are still going to be going up to the taskbar and typing in these web addresses? I think they will on some level, but I don't think it'll be nearly as much as they are doing it now.
That just reminds me quickly of one of the greatest purchases was the FB.com, which I think was the Farm Bureau of America. And obviously Facebook went and acquired it for a pretty sum back in the day. So you can make money if you have the right domain name.
I own several domain names, and it's one of those things where I'll get myself in trouble if I've had a few glasses of wine, and I'll think of a great idea, and I'll go and I'll spend $10 and buy a web domain name. And I have never had a single person offer me for my host of brilliantly clever web domain names.
We had a developer once who used to, in the early days, he acquired hundreds of domain names and was just sitting on them. And he must have sold a few, because one day I just got a resignation letter and he told me he was moving to Thailand and had bought a house over there.
And buying a Ferrari.
That's it. Okay, so from one monopoly in the US, we're going to start talking about some, I think what it's fair to call them, monopolies in Australia. But first, I just wanted to let members know that we have a secondary offer open for the Intelligent Investor Australian Equity Income Fund at the moment. Nathan's quite excited about this fund because we do believe we've got some good opportunities in the market right now. We did this 5-stock mini portfolio for income investors I think a week or two ago. Gives you an idea of the kind of stocks that we've got in the fund and how excited we are about them. So now's a good time to take a look. There's a webinar that's being recorded tomorrow, which unfortunately members won't be able to participate in because you're not going to hear this until Friday, but you can go onto the website to have a look at the recording, and you can visit offer.intelligentinvestor.com.au/INIF for details. Okay, moving right along. We're in the middle of reporting season, and we've recently reviewed Seek and car sales and realestate.com.au, which is the REA group. We're going to have a discussion about these three businesses because they often rank on our top 10 best businesses in Australia, but they seem to have produced a range of very, very different results. So, Nick, do you want to kick us off and just describe what's going on in reporting season for these three companies?
Yeah, I think I'd probably kick it off by just the broad comment that I don't think Seek is now in the top 10 best businesses in Australia. I think there's still an argument for car sales, definitely for REA. I consider REA maybe number one, but at least in the top three. But I no longer think Seek is in there. And the reason why is I mean, they just had another abysmal result, and it wasn't just that volumes for job ads were down, because volumes can move around a lot. The business is just very, very complex. So you've got on one hand, you've got this Australian, New Zealand business that's quite excellent. That's the business that we know and see, every day. But on the other hand, you've got these Asian operations that are split between emerging and developing countries. They've owned the business for a decade, and it's produced, satisfactory but pretty varied results. And the results here have got worse recently. So the market share in Asia fell from about 24% of placements to 21%. So they're sort of going backwards. And I was sort of the opinion they've got this new tech platform that they could go and accelerate, take market share, and really grow that business, but that just doesn't seem to be happening. And the other thing that's makes Seek really complex is the Seek Growth Fund, and they pay $18 million to manage that fund. And the manager is the ex-founder, one of the Bassett brothers, and they exclude that from profits. So that's a bit of a red flag. It's worth about $2 billion to them, but it's hard to know exactly if that's an accurate figure because there's so many venture capital bets in there. And just overall, if you ignore valuation, I just think car sales and REA are better businesses, and that's probably to do with market share, less complexity, and volumes. If you just look at volumes, the job market tends to fluctuate more, so you have higher highs and lower lows. So in COVID, Seek's volumes fell 60% lower than where they started. For REA, that number was minus 30%, and for car sales, just because of the specific crisis it was, volumes actually rose. And so for REA and car sales, the 3 Ds, so debt, divorce, and death, really provide a floor under volumes. So if you have an elderly family member that dies, usually you sell the family home and you sell a car, whereas they usually retired. So there's no impact on the job market. So there's a lot more support for volumes for car sales and REA compared to Seek. And then Seek has a bit more competition as well.
Yeah. Is Seek a case of diversification?
Yeah, absolutely. I think at the start, Asia showed a lot of promise. So they bought the Asian. They originally invested in Asia, I think in 2008, but they acquired the whole chunk in 2014. So it's been a decade of ownership. There's been a lot of ups and downs, and I'd rather if it was just Seek, just the core business, similar to what REA is. I know they've got a small bet in India, but it's very, very small compared to their Australian business. And I'd much prefer that than what Seek has done. The other thing is Seek has a history of doing this. So they only recently got out of Mexico and Brazil, which they had for a decade or more, and they just were awful investments and cost them a ton of money and soaked up a ton of management's time. So it's I just prefer the other two. And if you look at the UK market, where in the Intelligent Investor Select Value Fund we own Rightmove and Auto Trader, they specifically say we're not going to expand overseas. We're going to give money back to shareholders and stay within the UK and expand, into other parts. So for Rightmove doing property, they'll expand into commercial real estate and other areas, and then Auto Traders trying to move more into the car buying journey or digitalizing the car buying journey. Seek, there's just not much of that.
Okay, so we lowered the buy price on Seek for those reasons. You don't sound very enthusiastic on the long-term prospects for the company, though, but as long as you accept the cyclicality and the fact that Asia isn't great, you still feel as though you would buy below $16? Yeah,
no, I would. And that is a comment on how good the Australian business is, or Australian New Zealand business, rather than the overall, overall company. Again, the Seek Growth Fund complicates things, and Asia, I just think, sort of unnecessary, to be honest.
Yeah.
How much of this do you see as kind of the competitor here is LinkedIn, which has just been so effective as kind of an integrated social network, and that sort of a threat doesn't really seem to be as possible in kind of real estate or in automotive?
Yeah, you're 100% right. The competition for the job marketplace is much larger than it is in car sales or real estate. So you've got LinkedIn, who are sort of attacking the white collar jobs, and then you have even like a Facebook, like a coffee shop now doesn't really need to post an ad anywhere else other than its Facebook page, and they'll pick up a barista pretty quickly. And then you've got competitors like Indeed that are quite large as well. So Seek enjoys they have their share of ad placements are 2 times greater than their nearest rival, but they're only 33%. That's in Australia and New Zealand. So it's only a third. Whereas if you look at REA, it's 75% market share, Domain has about 25%, and car sales, I'm not sure of the exact figure, but I think it's somewhere between 80 and 90. So they're just far, far more dominant with far less competition compared to these job marketplaces.
Angus, any comments on the online classifieds sector? I mean, do you still think that these are, regardless of price, these are nice kind of monopolies to buy and that members should look to own in their portfolios?
Yeah, I mean, there's certainly some really good examples of great businesses. The landscape's interesting where, that they can get kind of deplatformed and undercut. But I think anywhere where it's a sector where, it's even interesting kind of thinking about the customer base, because automotive, you've got large car dealerships and you've got large real estate agencies that are kind of the bulk of the customers. So it's sort of just a different sales cycle to, the job market. It's much, much more fragmented. A lot of businesses have their own in-house hiring, and it's not a space that I'm particularly deep on, but you can see the structural differences, I think. But yeah, I think classifieds can be just incredible businesses, really, because you kind of can just be, taking a clip on a way of doing business, a fundamental way of doing business.
Yeah. Okay. It's reporting season. I know you guys are busy, so I think we need to wrap it up. Thanks very much for your attendance. I suggest you both go off and have an ice bath if you're going to last those 10 years so you can disappear in reporting season and then get back stuck into it. So thanks very much, Angus, and thanks a lot, Nick. We'll speak to you all soon.